Hey, what's up everyone and welcome back to the channel. If you're new here, hit that subscribe button right now because we're about to dive deep into a company that doesn't usually make headlines, but has been quietly crushing it in the stock market for decades. Today we're talking about AutoZone. Ticker AZO. And I know that some of you are thinking, auto parts, really? That's not exactly Tesla or NVIDIA. But stick with me, because this is going to be a masterclass in how boring businesses can sometimes be the most consistent wealth builders. So before we jump in, smash that like button if you want to see more deep dives like this. It actually helps the algorithm push this content to other investors who are trying to learn how to analyze companies like the pros do. Here's the thing about AutoZone that most people don't realize. While I was chasing the latest AI stock or crypto trend, this auto parts retailer has been steadily compounding wealth for shareholders. We're talking about a company that's outperformed many of the flashy tech names over the last decade. Why? Let me tell you why. Because AutoZone operates on a simple but powerful principle. The principle is cars always break down. Whether the economy is booming or we're in a recession, people need to fix their vehicles, right? And when your alternator dies on a Saturday morning and you need your car for work on Monday, you're not shopping around for the best deal online. No, you're not gonna do that. What are you gonna do? You are going to the closest store that has the part in stock. That makes AutoZone what we call a defensive stock, a company that can hold up even when everything else is falling apart. It's not going to make you rich overnight, but it might keep you wealthy when the market gets ugly. We just got AutoZone's Q4 fiscal 2025 earnings results, and there's a lot to unpack. We're going to break down their financial numbers line by line, analyze what management is telling us in the presentation, look at third-party analysis from the earnings call, and I will give you my final verdict on whether this is a buy, hold, or avoid in today's market. But more than that, we're going to teach you how to read earnings report like a Wall Street analyst, like a Wall Street analyst. All right? How to spot the accounting tricks, how to separate a signal from noise, and how to think about evaluation and competitive positioning. Whether you end up buying AutoZone or not, you are going to learn skills that apply to analyzing any company. So, for those who are not familiar, AutoZone is the largest auto parts retailer in the United States. You've probably seen their bright yellow and red stores. They're everywhere. And they sell everything your car needs. Batteries, brake pads, oil filters, windshield wipers, all the stuff that keeps cars running. They serve two main customer types. First, there's a DIY crowd, weekend warriors, who change their own oil and replace their own brake pads. Second, there's a commercial business, professional mechanics, repair shops, and fleet operators who buy parts in bulk and need them delivered fast. And besides that, AutoZone has also expanded internationally with hundreds of stores in Mexico and Brazil, and they've built some interesting businesses like AllData, ALLDATA, which provides diagnostic software to mechanics. So here's what makes AutoZone interesting as an investment. They've been incredibly disciplined about capital allocation since 1998. They've spent over $38 billion buying back their own stock. That's reduced the number of shares outstanding by more than 80%, which mechanically boosts earnings per share. They generate massive amounts of fresh cash flow. They're talking about nearly $2 billion this year, and they have a return on invested capital over 40%, which is elite territory. Most companies would kill for a 15% return on capital. The business model is also pretty defensive. Even in a recession, people keep fixing their cars rather than buying new ones. In fact, economic downturns can actually help AutoZone because when money is tight, people hold on to older vehicles that need more repairs. But it's not all smooth sailing. No, AutoZone faces some real challenges. Competition from companies like O'Reilly Automotive and Advanced Auto Parts is always fierce. E-commerce is growing, though it's still a small part of the auto parts market because customers often need parts immediately. The biggest long-term question is electric vehicles. EVs need fewer replacement parts, no oil changes, fewer moving components to break down. Right now, EVs are only about 8% of new car sales, and the average car on the road is over 15 years old, so this isn't an immediate threat, but it's something AutoZone will need to adapt to over the next decade or two. There are also near-term headwinds. Inflation has been hitting their cost structure. They've been dealing with supply chain challenges, and they've been investing heavily in new store expansion, which pressure margins in the short term. And so let me tell you what to expect in this analysis. We're going to start by diving into the actual financial results. I will walk you through their economic statement, balance sheet, and cash flow statement, explaining what each line means and why it matters for investors. Then we will look at their management presentation. This is a PowerPoint deck they use when talking to analysts. This shows you what story management wants to tell and what metrics they are most proud of. After that, let me show you my agenda. Just 1 second. All right, this is the agenda. Well, let me check where we were at. Yeah, I'll give you my take on whether it's a buy, hold, or avoid those metrics. So before we dive into the numbers, let me share something important about investing to you guys. So the market is obsessed with growth stocks and momentum plays, right? And there's nothing wrong with having some of those in your portfolio, but the companies that constantly build wealth over decades are often the boring ones that just execute really well. AutoZone sells brake pads and oil filters. That's not going to change the world, but they do it better, faster, and more conveniently than most anyone else. They've turned that simple business into a wealth-creating machine. The lesson isn't that you should only buy boring stocks. The lesson is don't ignore steady compounders just because they're not flashy. They're often the stocks that keep working when everyone else falls apart. All right. Well, I think enough setup. Let's dive into AutoZone's Q4 earnings and figure out whether this steady compounder deserves a place in your portfolio. Make sure you are subscribed because we will do deep dives like this every week. or even every day, we will be here on the YouTube, and we will do the live stream every day. Maybe not every day for the earnings report analysis, but we will definitely be here every day at 9 a.m. right before the market opens, and we will be teaching you how to analyze companies like a professional investor every week. Drop a comment and let me know if you ever shopped at AutoZone, or if you've ever considered investing in this retailer but a profitable business like this. I want to hear what you think about defensive stocks versus growth stocks in today's market. So here we go, let's break down AutoZone's latest results and see what the numbers are really telling us. So let me break down what just happened in their Q4 earnings report. This is the AutoZone's official website, and we can go to their investor relations. So this is the investor relations sector, the portal of their official website, and as you can see, this is the latest link. On September 23rd, 2025, they posted their press release, and also this Q4 2025 AutoZone earnings conference call. So now I'm gonna break down those numbers in the Q4 earnings report. Let me show you. So this is the PowerPoint from their official website. Now, before we go to the earnings, let's just check this press release. All right, let's go through that together. AutoZone reported earnings per share of $48.71. Wall Street was expecting over $50, so that's a miss, not very great. Revenue came in at $6.24 billion. That's basically flat compared to last year, up just 0.6%. 0.6%, just up just 0.6%. In this market, flat growth isn't exciting anyone, no. But here's the kicker, and this is very important for beginners. Same-store sales grew 5.1%. What does that mean? It means their existing stores are selling more stuff without having to build new locations. That's actually really healthy. It shows it's really healthy. It shows people are coming back, buying more, and the core business is strong. Think of it this way: if like McDonald's same-store sales are growing, it means people are buying more Big Macs at the McDonald's that already exist. That's way better than just building more McDonald's to get higher total sales, right? So why this matters right now? Here's where macro environment actually helps AutoZone. Interest rates are still high, right? That means car loans are expensive. So fewer people are buying new cars. What do they do instead? What do? They keep driving their old cars and fix them when they break, instead of buying a new one. This is like a gift to AutoZone. The harder it gets to buy a new car, the more money people spend fixing their current one. It's beautiful from an investment perspective. And let's be real about the competition here. Sure, you've got O'Reilly Automotive and Advanced Motor Parts trying to grab market share, but AutoZone has over 7,000 stores. You know what? 7,000 stores. That's amazing. That's massive scale. When you need a car battery at 8 p.m. on a Sunday, you're going to the closest auto parts store, and chances are that's AutoZone, right? Now, here's what blows people's minds about AutoZone. This boring auto parts company has crushed the market over the last decade. We're talking about a stock that's outperformed a lot of flashy tech names everyone obsesses over. How? How exactly? Share buybacks. So, AutoZone has been aggressively buying back their own stock for years. Here's how that works in simple terms. Imagine there's a pizza cut into 10 slices, and you own one slice. If the company buys back and destroys 5 slices, now there are only 5 slices in total, right? So your 5 slices total, so your one slice represents a bigger piece of the whole pizza. That's what share buybacks do. They make your ownership worth more. AutoZone has reduced their share count by massive amounts. Fewer shares outstanding means earnings per share goes up, even if total earnings stay flat. It's like financial engineering. That they've been masters at it. Okay, so let's address the big question everyone's thinking. What about electric cars? EVs need way fewer parts, no oil changes, fewer moving parts, less stuff to break. Doesn't that kill AutoZone's business? Here's the reality check. Alright? So the reality check right now, EVs are still maybe 80% of new car sales. And remember, AutoZone doesn't make money from new cars. They make money from old cars that need fixing. The average car on the road today is over 12 years old. Even if every new car sold tomorrow was electric, it would take decades for the existing fleet of gas cars to disappear. Plus, EVs still need tires, windshield wipers, air filters. It's not like they're maintenance free. No, EVs are not maintenance free. AutoZone has time to adapt, and they're already stocking EV parts. But let's not sugarcoat the challenges. No, we're not gonna do that. This is their 5th straight quarter of missing earnings expectations. That's not a good trend. The problem is costs. They're opening new stores, stocking more inventory, dealing with inflation like everyone else. Their SG&A expenses, that's selling, general, and administrative costs, they're creeping higher. When costs rise faster than sales, profit margins get squeezed. That's exactly what's happening here. AutoZone is growing, but it's getting more expensive to grow. So here's my take. AutoZone isn't going to make you rich overnight like some AI stock might, but it's that steady, reliable holding that keeps your portfolio stable when everything else is going crazy. If you're building a balanced portfolio, and beginners, this is crucial. You want some of these defensive, boring companies alongside your growth picks. When tech stocks are having a bad day, companies like AutoZone often hold steady or even go up. The earnings miss is concerning, but the same-store sales growth tells me the underlying business is healthy. People are still shopping at AutoZone. They're just dealing with some growing pains on the cost side. Before we wrap up, smash that like button if this breakdown was helpful, and definitely subscribe because we're diving deep into earnings like this every week. Drop a comment and let me know, do you think AutoZone can keep growing, or are rising costs going to be a problem? I want to hear your thoughts, guys. The bottom line on AutoZone is not sexy, but it works. In a world where everyone's chasing the next big thing, sometimes the most boring businesses make the best investment. just something to think about as we head into the rest of the earnings season. What do you think? Are you bullish or bearish on AutoZone? Let me know. Let me know in the chat. Thank you so much. Alright, let's get our hands dirty and dive into the actual numbers. We're going straight to the source here, AutoZone's official press release that just dropped. This is where the real story lives, not in some analyst summary or Twitter X hot take. So here's what AutoZone just reported for Q4. Net sales came in at $6.2 billion for the quarter. Now that's only up 0.6% compared to last year, which sounds pretty weak, right? But hold up. There's a twist here that's super important. Last year's Q4 had an extra week in it. Yeah, you heard that right, an extra week. This happens sometimes with fiscal calendars. So if we adjust for that extra week, sales were actually up 6.9%. That's a massive difference. Think about it like this. If you worked 5 days this week and made $500, and last week you worked 6 days and made $600, it might look like you're going backwards, but when you calculate it per day, you're actually doing way better. That's exactly what's happening with AutoZone's numbers. This is why you always need to read the fine print, folks. The headline number can be misleading sometimes if you don't understand what's underneath it. Now let's talk about the same store sales, because this is where the rubber meets the road. For those new to retail investing, same store sales only count stores that have been open for at least a year. Let me repeat that. So for beginners, for those of you who are new to retail investing, let me repeat that for you guys. Same store sales only count stores that have been open for at least a year. It's a purest measure of whether the business is actually growing or if they're just making numbers look better by opening new locations. In the US, same-store sales were up 4.8% for the quarter. That's solid growth, especially in this economic environment when people are worried about their jobs and inflation's eating into their wallets. A 4.8% increase means customers are still choosing to spend at AutoZone. Internationally, it gets more interesting. The raw number was only 2.1% growth, but when you adjust for current exchange rates, meaning you strip out the effects of the dollar getting stronger or weaker against other currencies, it jumps to 7.2%. So here's why currency matters. Let me explain it for you why the currency matters. Let's say AutoZone sells $100 worth of parts in Mexico, and a peso was 20 cents. That's $20 in US dollars. But if the peso weakens to 15 cents, that same 100 peso sale is now only worth $15 in US dollars. The business is doing great in Mexico, but it looks worse when converted to dollars. So the total company same-store sales were up 4.5% or 5.1% when you adjust for currency. That tells me the core business is healthy across the board. Alright, here's where the story gets complicated, and this is important for understanding why the stock might not be celebrating these sales numbers. Gross profit margin. That's what AutoZone keeps after paying for the cost of the parts they sell, came in at 51.5%. That's down nearly a full percentage point from last year. In retail, margins are everything, so this is concerning. the big culprit here is something called LIFO. LIFO charge of $80 billion. LIFO stands for last in, first out. It's an accounting method. Let me give you a simple example to explain this. So LIFO, L-I-F-O, it stands for last in, first out, and it's an accounting method. Imagine you're stocking your garage with motor oil. You buy 10 bottles at $5 each in January, and then 10 more at $7 each in March because of inflation. Under LIFO accounting, when you sell oil, you assume you are selling the $7 bottles first, even if you're actually grabbing the $5 ones from the back. When inflation hits hard like this, LIFO makes your costs look higher, which squeezes your reported margins. That $80 million LIFO charge is basically AutoZone saying, inflation made our inventory way more expensive. But it doesn't stop here. Operating expenses rose to 62.4% of sales, up from 61.6% last year. Why? Because AutoZone is investing heavily in growth. They're opening new stores, stocking more inventory, hiring more people. Growth costs money up front. All these rising costs pushed operating profit down 7.8% to $1.2 billion. Net income. So this is a LIFO impact that we just talked about. The actual money left over after everything, that's net income, dropped to $837 million from $902 million last year. Here's a number that really matters to investors. Earnings per share fell to $48.71, down about 6% from last year. And here's a kicker. This is how AutoZone's fifth straight quarter of missing Wall Street's earnings expectations. Let me put that in perspective. When a company misses earnings expectations once, it might be a bad luck or something, or timing or something. When it happens 5 quarters in a row, that's a pattern. Either the company is struggling more than expected, or Wall Street analysts haven't adjusted their models to the new reality. Let's zoom out to the full fiscal year. AutoZone brought in $18.9 billion in sales, up 2.4%. Annual earnings per share was $144.87, down from $148.55 last year. So we've got a company where revenues are growing slowly, but profits are actually declining. That's exactly what happens when costs rise faster than sales. It's not necessarily a death sentence. No, that's not a death sentence. But it's definitely a yellow flag that investors need to watch. Now, let's talk about something AutoZone does really well: share buybacks. We're going to talk about the share buybacks. So this quarter, they repurchased 117,000 shares, spending about $447 million at an average price of $3,821 per share. For the full year, they bought back 447,000 shares, spending $1.5 billion. Why does this matter? It's very simple. It's simple math. If there are fewer shares outstanding, each remaining share represents a bigger piece of the company. Let's go back to the pizza I just mentioned. It's like having the same pizza, but Cutting it into fewer slices, each slice gets bigger. AutoZone has been absolutely relentless with buybacks over the years. They've reduced their share count by massive amounts, which helps boost earnings per share even when total earnings are not growing as fast. One more important detail, AutoZone reported inventory up 14.1%. Compared to last year, that means their shelves and warehouses are more loaded than they've been. This could be good or bad. On the good side, it means they're prepared for demand and less likely to lose sales because they are out of stock. On the bad side, too much inventory ties up cash and creates risk. If demand doesn't materialize, they might have to mark down products to clear them out. Think of it like stocking your fridge before a big party. You want enough food, right? You want enough food and drinks for everyone. But if you overdo it, you're stuck with a bunch of stuff that might go bad. Let's decode what the CEO said. I will highlight it for you guys. I would like to thank the entire organization for delivering another strong quarter of sales growth. We continue to be pleased with the results of our strategies to grow both domestic and international DIY and commercial sales. Domestically, both DIY and commercial sales improved sequentially throughout the quarter, and we're pleased with our momentum heading into our new fiscal year. Let me highlight this. This is what the CEO said. And our international business also continued to deliver strong results, growing same-store sales 7.2% on a constant currency basis. We were especially pleased to have opened 141 net new stores globally in the quarter. Until here. That's all what the CEO said. So let's decode what he said, the CEO. I will discuss that in plain language so everyone can understand, right? In human language. He said sales growth is strong in both the US and internationally, and that both DIY customers and commercial accounts improved as the quarter went on. So what's a DIY? DIY means regular people like you and me fixing our cars in the driveway on weekends. Commercial means professional mechanics and repair shops buying parts in bulk. When both sides of the business are growing at the same time, that's like a restaurant being busy at lunch and dinner. The whole operation is working. And the CEO also bragged out opening 141 net new stores just this quarter, 304 for the full year. His message was clear: we will keep investing, keep opening stores, and keep focusing on earnings and cash flow. That's management speaks for. We are playing the long game even if it hurts short-term profits. So speaking of stores, let's talk about AutoZone's expansion strategy because it's pretty aggressive. For this quarter alone, they opened 91 new US stores, 45 in Mexico and 6 in Brazil. They only closed one store, so net growth was 141 stores. Their total footprint now sits at 7,657 stores, 6,627 in the US, 883 in Mexico, and 147 in Brazil. That's a massive network and proximity matters in this business. Here's why. When your water pump dies on a Saturday morning and you need your car for work on Monday, you're not comparison shopping online for 3 days. You're going to the closest auto parts store that has the parts in stock, right? That's AutoZone's competitive advantage. They are everywhere, literally everywhere. But rapid expansion has risks too. Let's talk about the risks. So, one of the risks is bad locations and higher rent, staffing challenges, training quality, right? All of these. Growth can hide mistakes until the economic cycle turns, and suddenly those marginal locations start losing money. For those new to the company, let me break down what AutoZone actually does. I've talked about it. I want to dig deeper. They are the leading retailer and distributor of the replacement auto parts in the Americas. Walk into any of their stores and you will find thousands of parts for cars, SUVs, vans, and light trucks. They've got hard parts, the mechanical guts like alternators, starters, and brake calipers. And they've got maintenance items like oil filters, air filters, and windshield wipers. They've got accessories like floor mats and foam mounts. They even sell some non-automotive products, but here's what makes AutoZone interesting from an investment perspective. Most stores run a commercial program too. Most stores run a commercial programs too. That means they deliver parts to professional repair stores, official credit terms, and build relationships with mechanics who order parts every single day. That commercial business is incredibly sticky. Once a repair shop gets used to AutoZone's delivery routes, credit terms, returns, and inventory system, switching to a competitor's is a huge pain. It's like changing banks. Technically possible, yes, but such a hassle that most people don't bother unless they're really unhappy. AutoZone also owns some interested assets that don't get much attention. They own AllData, which is software that helps mechanics diagnose problems and find repair procedures. It's like giving mechanics both the recipe book and the kitchen timer. They also have Duralast, their house brand of parts, which typically carries higher margins than selling national brands. One important thing to understand, AutoZone doesn't install the parts. No, they don't do that. They do not install the parts. They sell you the alternator, but they don't put it in your car. That keeps them out of service business, which means no labor costs, no warranty liability, and no need to hire skilled mechanics. No, they don't do that. Now let's talk about some of the accounting stuff that appears in these reports. So AutoZone includes what we call the non-GAAP measures, non-GAAP measures. That's a finance speak for adjusted numbers that try to show you what the business looks like if you strip out one-time events or accounting quirks. For example, they adjust out that actual week from last year to make the comparison fair. They calculate return on invested capital, which tells you how efficiently they return. They calculated the return on invested capital, and that tells you how efficiently they turn investments into profits. They also look at debt relative to earnings, which helps you understand their financial health. Here's a key for beginners. Non-GAAP isn't fake. No, non-GAAP is not fake, but it's a different lens. GAAP is the legal official version of the books. Non-GAAP is management's version of here's what we think the business really looks like. Use both. The GAAP tells you the GAAP. GAAP tells you what actually happened. Non-GAAP tells you what management thinks you should focus on. The truth is usually somewhere in the middle. Now let's talk about the risk. The risk factors, what could go wrong. Every earnings report includes what's called a safe harbor statement, basically a list of everything that could mess with a company's plans. So AutoZone's list is pretty long. Yeah, pretty long. Fuel prices, weather, competition, credit markets, consumer debt, inflation, cyber attacks, supply chain problems, tariffs, geopolitical risks, recession risk. Don't panic, guys. Don't panic when you see these lists. Every public company has them, but as investors, we should focus on the risks that are most relevant right now. So for AutoZone, I'd watch inflation and wage pressure, which squeeze margins. Inventory management is crucial. Too much inventory means markdowns. Too little means lost sales. Stop expansion execution matters because new stores need to generate returns that exceed their costs. And cybersecurity is crucial because if their systems go down, commercial stops. By the way, AutoZone hosted their earnings call at 10 a.m. Eastern Time. 10 a.m. Eastern Time on September 23rd, 2025. You can listen on their website under the Investor Relations, where we're at right now. Let me show you. Yeah, here we go. Investor Relations. I'd recommend turning into the Q&A section. That's where analysts ask the tough questions about margins, same-store sales trends, inventory strategy, and store expansion returns. Pay attention to management's tone. Are they defensive? Are they confident? Overly promotional? Sometimes how they say things matter as much as what they say. So where does this leave us on AutoZone? Let me give you the bull case, the bear case, and the neutral case. The bull case. Adjusted sales growth of nearly 7% shows underlying demand is strong. Some store sales growth in both the US and internationally prove the business model works. Aggressive shares buybacks show management confidence. This is still a steady compounding machine in a defensive industry. And what about the bear case? 5 straight quarters of earnings misses is concerning. It's really concerning. Margins are getting squeezed by inflation and rising costs. If expenses keep climbing faster than sales, profits could stagnate. Plus, there are long-term questions about electric vehicle adoption affecting demand for traditional auto parts. Now let's move to the neutral case. This is what AutoZone is like, not flashy, not crashing, just grinding away. Steady sales growth, some margin pressure, and long-term adaptation challenges. This is a defensive stock for investors who want reliability over excitement. Before we move on to the next segment, I want to hear from you guys. Are you more impressed by the store growth and same-store sales? Are you impressed? Or are you worried? Are you more worried about the margin pressure and earnings misses? Drop your thoughts in the chat. Guys, drop your thoughts in the chat, let me know. And if this deep dive is helping you understand how to read earnings report, Smash that like button, thank you so much. Subscribe to my channel. We are breaking down complex financial reports like this every week, making them accessible for everyone from beginners to professionals. And if you're interested, please click the link in the chat. Join our WhatsApp group chat. Thank you so much. It's pinned in the chat. Next up, we are going to look at AutoZone's balance sheet and cash flow statement to see how financially healthy this company really is. How financially healthy this company really is. Trust me, you won't want to miss that part. It's where some of the most important insights are hiding. Alright everyone, we've reached what I like to call the wall of numbers section of AutoZone's earnings report. This is where it gets real. No more corporate speak, no more fluffy management commentary, just a cold hard financial data that tells us exactly what's happening inside this business. Don't worry if numbers make your eyes glaze over. I'm going to walk you through every single line item and translate it into plain language. By the end of this section, you will understand AutoZone's financials better than most Wall Street analysts. Let's dive in. So, let's start with the income statement. Income statement, which is basically AutoZone's report card for the quarter. Think of it like tracking your personal finances, money coming in, money going out, and what's left over at the end. Net sales came in at, maybe we can switch to this part. Yeah. Net sales and net sales, where is it? Oh, here we go. As you can see, net sales. Oops. I just want to highlight it for you guys. But I'm pretty sure as we talk about it, you can see it clearly, right? If you cannot, just let me know in the chat. Thank you so much. So net sales came in at $6.243 billion for the quarter. That's every dollar that went through the cash registers at all 7,657 AutoZone stores around the world. To put that in perspective, that's about $815,000 per store for the quarter, or roughly $2,700 per store per day. Now, AutoZone didn't get to keep all that money. They had to pay for the parts they sold. Cost of sales was $3.026 billion. That's what AutoZone paid to buy all those brake pads, batteries, and oil filters from manufacturers. Subtract the cost of sales from the net sales and you get a gross profit of $3.216 billion. Yeah, $3.216 billion. That's what AutoZone keeps before paying for everything else: rent, employees, electricity, marketing, you name it. Here's a key metric for beginner: gross margin. Gross margin. AutoZone's gross margin was 51.5%. That means for every dollar that came in the door, they kept about 52 cents after paying for the products. The other 48 cents went to suppliers. Is this 51.5% good? In retail, it's pretty solid. Grocery stores might run 20 to 25% gross margins. Electrics retailers might be 15 to 20%. Auto parts retailer can command higher margins because when your car breaks down, you need the part regardless of price, right? But here's the concerning part. AutoZone's gross margin was 52.4% in the same quarter last year. So they're actually keeping less of each sales dollar than they were a year ago. That's margin compression, and it's a red flag for investors. After the gross profit, AutoZone has to pay for everything else it takes to run the business. These are called operating expenses, specifically SG&A, selling, general, and administrative expenses. SG&A came in at let me check. So as you can see, SG&A expenses, as I mentioned, that's selling, general, and administrative expenses. SG&A came in at $2.02 billion for the quarter. Let me break down what that includes. So this includes store payroll for all those employees, helping customers find parts, rent for 7,657 stores across 3 countries, utilities to keep the lights on and the cash registers running, marketing to get people in the door, and corporate headquarters costs, distribution center operations, delivery trucks for the commercial business. Think of SG&A as a cost of being in business. Well, I think in that way, it's simple. Even if AutoZone sold 0 parts in a quarter, most of these costs could still exist. The problem is that SG&A as a percentage of sales went up. It was 32.4% of sales this quarter versus 31.6% last year. That means AutoZone is spending more to generate each dollar of sales. That's the opposite of what you want to see. In a healthy, growing business, you'd expect SG&A as a percentage of sales to go down over time. That's called operating leverage. You spread your fixed costs over more sales. The fact that it's going the wrong way tells us AutoZone is dealing with some challenges. Yeah, definitely some challenges. I mean, after subtracting SG&A from gross profit, you get operating profit of $1.196 billion. Here, operating profit, that's $1.196 billion. You see that? Let me know if you got it, guys. Let me know in the chat. That's what the business actually made before paying interest on debt and taxes to the government. Operating profit dropped 7.8% compared to the last year. The operating profit dropped. That's concerning because it means the core business is less profitable than it was 12 months ago. After interest and taxes, AutoZone had net income of $836.9 billion. Yeah. Here we go. This one. No. Divide that by the number of shares outstanding and you get earnings per share of $48.71. $48.71. Yeah. Here we go. Diluted. So here's where the share count becomes really important. AutoZone had $17.18 million diluted shares outstanding this quarter, down from $17.49 million last year. Remember our pizza analogy? Remember the example that I just mentioned twice, the pizza stuff? It's like cutting the same pizza into few slices. Each slice represents a bigger portion of the total. This is why AutoZone's earnings per share only fell to $48.71 from $41.58. Even though total net income dropped more dramatically, the company bought back shares, which cushioned the per share impact. But here's what's interesting for beginners to understand. Share buybacks can be good or bad, depending on the context. If the company is buying back stocks because the business is generating excess cash and the stock is cheap, that's great for shareholders. But if a company is buying back shares to artificially boost earnings per share where the underlying business is struggling, that's financial engineering that can backfire. The key question is whether AutoZone's buybacks are creating real value or just masking problems. We will see. Now let's talk about those adjustments for the actual week, because this is crucial for understanding what really happened. Last year's fourth quarter had 17 weeks instead of 16. This happens sometimes because of how fiscal calendars work. It's like comparing your monthly salary to a month that had 35 days instead of 30 days. The numbers would look different even if nothing fundamental changed. When AutoZone adjusted for that extra week, the comparison looks much better. On a 16-week to 16-week basis, sales were $6.243 billion this year versus an adjusted $5.84 billion last year. That's actually 6.9% growth instead of the 0.6% growth you see without adjusting. Operating profit on an adjusted basis was $1.196 billion this year versus $1.21 billion last year. So operating profit was essentially flat when you make the comparison fair. Earnings per share on an adjusted basis was $48.71 this year versus $48.11 last year. That's actually a small increase instead of a decrease. This is why it's so important to read the fine print in earnings reports. Yeah, it's really important to read the fine print in earnings reports. The headline numbers can be misleading if you don't understand the adjustments. Looking at the full fiscal year gives us a better sense of the overall trends. Full year sales were $17.939 billion, up 2.4% from last year. That's pretty modest growth for a company that's been expanding its store footprint aggressively. Full year operating profit was $3.610 billion, down from $3.789 billion last year. Again, we see the pattern of revenues growing slowly while profits decline. The profits decline and the revenues grow slowly. Full year earnings per share was $144.87. down from $149.55 last year. Even when you adjust for last year's 53rd week, EPS was still down slightly. For a company that's been a consistent earnings grower for decades, these numbers represent a challenging period. The question is whether this is temporary margin pressure that will reverse or a sign of more structural problems. We don't know, but we will see. Now let's look at AutoZone's balance sheet. Which is like a snapshot of what the company owns and owes at a specific point in time. Cash on hand was $278 million. One second. So we're just talking about the cash on hand, $272 million. And for a company like this with nearly $19 billion in annual sales, that's not a lot of cash. But that's actually normal for AutoZone because they return most of their cash to shareholders through buybacks rather than hoarding it. Inventory was $7.026 billion, up from $6.155 billion last year. That's a 14.1% increase, which is much higher than the 2.4% increase in sales. This suggests that AutoZone is either preparing for a higher demand, dealing with supply chain issues that require more safety stocks, or having trouble moving inventory as quickly as expected. Total assets were $19.36 billion. Total debt was $8.8 billion, down from $9.02 billion last year. So AutoZone actually reduced its debt load, which is generally positive. Generally, it's positive. Here's where things get interesting for beginners. AutoZone shows negative shareholders' equity of minus $3.41 billion. If you are new to finance, that might sound terrifying. Negative equity means the company owns more than it owns, right? But in AutoZone's case, this isn't a sign of financial disasters. No, that's not a financial distress. It's actually the result of aggressive share buybacks over many years. When a company buys back billions of dollars worth of stocks, it reduces shareholders' equity on the balance sheet. Think of it this way. Like if you took out a loan to buy back shares of your own company, your personal balance sheet will show more debt and less equity, right? Even though you might be in great financial shape. AutoZone also shows negative working capital, which again might sound scary, but is actually common for retailers. Working capital is current assets minus current liabilities. Let me repeat that because I think it's really important. Working capital is current assets minus current liabilities. When it's negative, it means the company owns more in the short term than it has in liquid assets. But here's the thing, retailers often get favorable payment terms from suppliers. AutoZone might get 30 or 60 days to pay for inventory, while they sell that inventory for cash immediately. That's actually a source of free financing. For retailers like AutoZone, traditional data metrics don't tell the whole story because so much of their cost structure is rent rather than debt. When you lease thousands of stores that rent acts a lot like debt payments. That's why analysts use a metric called EBITDA, earnings before interest, EBITDA. That's a metric. EBITDA, earnings before interest, taxes, depreciation, amortization, and rent. For AutoZone, EBITDA was $4.811 million. No, sorry, not billing. Not million. I mean billing. EBITDA for AutoZone, EBITDA was $4.811 billion. They also calculated adjusted debt. Adjusted debt, which includes traditional debt plus lease obligations plus 6 times annual rent. This gives you a more complete picture of the company's obligations. AutoZone's adjusted debt was $11.978 billion. Adjusted debt divided by EBITDA gives you a leverage ratio of 2.5 times. That's unchanged from last year and is considered reasonable for a retailer. Most investment-grade retailers' target leverage ratio is between 2 and 3 times EBITDA. This tells us AutoZone isn't taking on dangerous levels of debt to fund its growth. This balance sheet is solid even if the income statement is under pressure. One of the most important metrics for any business is return on invested capital, or ROIC. This tells you how efficiently a company converts investments into profits. AutoZone suggested after-tax ROIC was 41.3% this quarter. Okay, here we go. So, adjusted after-tax ROIC. It was 41.3% this quarter. To put that in perspective, most companies would kill for a 15% ROIC. Anything above 20% is considered excellent. 41% is absolutely elite territory. But here's a concerning trend. ROIC was 49.7% in the same quarter last year. So while 41% is still fantastic. Yeah, it's fantastic. The direction is wrong. The efficiency of AutoZone's investments is declining. This matters because ROIC is ultimately what drives long-term stock returns. Companies with sustainably high ROIC tend to compound shareholder wealth over time. If AutoZone's ROIC continues to decline, it could signal that their competitive advantage are eroding. The question is whether this decline is temporary or maybe due to investments in new stores that haven't reached maturity yet, or whether it represents a more fundamental challenge. Now let's talk about the cash flow. Cash flow, which many investors consider more important than reported earnings. Cash flow is what actually goes in and out of the bank account, while earnings include various accounting adjustments. Operating cash flow was $3.155 billion for the year, up from $3.004 billion last year. That's actually encouraging. It shows the business is generating more cash despite the pressure on the reported earnings. Capital spending was $1.365 billion, up from $1.073 billion last year. That's money invested in new stores, distribution centers, technology, and other long-term assets. The increase makes sense. Yeah, it makes sense given AutoZone's aggressive expansion plans. Free cash flow, operating cash flow minus capital spending. What does it mean? Like a free cash flow, I mean. Let me explain. It's operating cash flow minus capital spending was about $1.79 billion. That's the cash available for paying down debt, buying back stock, or paying dividends. The fact that AutoZone generated strong free cash flow while investing heavily in growth is actually quite positive. It suggests the underlying business model is healthy, even if margins are under pressure. Now let's talk about this buyback machine. $38.5 billion and counting. AutoZone spent $446.7 billion on share buybacks in Q4 alone. At an average price of about $3,821 per share. For the full year, they spent $1.5 billion buying back stock at an average price of $3,425 per share. Here's a staggering number. Since 1998, AutoZone has spent $38.5 billion buying back its own stock. To put that in context, the entire company is worth about $65 billion today at current prices. Shares count has fallen from 17.49 million shares last year to 16.665 million shares today. Over the long periods, the reduction is even more dramatic. AutoZone had over 100 million shares outstanding in the late 1990s. This buyback program is both AutoZone's greatest strength and its biggest risk. Yeah, it's like a double-edged sword. It's been a huge driver for per share returns over the decades, but it also means the company is extremely leveraged to its own operating performance. If the business starts declining, all those buybacks at high prices could look like a mistake. But if AutoZone can navigate the current challenges and return to growth, shareholders will benefit enormously from the reduced share count. Let's dig into the nitty-gritty of AutoZone's store operations. Total store account is now 7,657 stores, 6,627 in the US, 883 in Mexico, and 147 in Brazil. Total square footage is 51.8 million. Sales per average store in Q4 were $823,000 versus $835,000 in last year's 17-week quarter. 17-week quarter compared to last year's. But remember, last year had an extra week, so on a comparable basis, productivity actually improved. For the full year, sales per average store were $2.523 million versus $2.505 million last year. So each store is generating slightly more revenue on average. Sales per square foot is another key retail metric. For Q4, it was $122 per square foot versus $124 last year, again affected by the actual week. For the full year, it was $374 per square foot versus $373, so essentially flat. These productivity metrics suggest AutoZone's real estate strategy is working. They're not just adding stores for the sake of growth. They're adding stores that contribute meaningfully to the business. One bright spot on the business is AutoZone's commercial business. This is a B2B site that serves professional repair shops, fleets, and dealerships. So let's talk about it, the B2B success story. Commercial sales in Q2 were $1.762 billion, up 6% versus last year. For the full year, commercial sales were $5.212 billion, up 6.7%. That's faster growth than the overall business. Average sales per commercial program per week were $1,800. I mean, $18,200, up 9% year over year. This tells us AutoZone is not just adding more commercial customers, but existing consumers are buying more. The commercial business is extremely valuable because it's much stickier than retail. Once a repair shop integrates AutoZone into their workflow, ordering systems, delivering routes, credit terms, switching into a competitor is a major hassle. Commercial customers also tend to buy higher margin parts and buy them more frequently. Professional mechanic isn't a comparison shopping for the cheapest brake pads. They want quality parts delivered quickly so they can get cars back to customers. Now let's talk about the same-store sales. The health of existing locations. Same-store sales growth is one of the most important metrics for any retailer. So the same-store sales measures sales growth at stores that have been open for at least a year, so it strips out the effect of new store openings. For Q4, domestic same-store sales were up 4.8%, international same-store sales were up 2.1%, or 7.2% on a constant currency basis. Total same-store sales were up 4.5% or 5.1% on a constant currency basis. They're actually pretty healthy numbers, especially in the current economic environment. It tells us people are still coming to AutoZone and buying more parts, even with inflation pressure, household budgets. The strength in international same-store sales is particularly encouraging. Mexico and Brazil are important growth markets for AutoZone, and seeing 7% constant currency growth suggests that their international expansion strategy is working. Now let's talk about the inventory management. Inventory management is crucial for any retailer, but it's especially important for auto parts companies because of the massive numbers of SKUs, individual part numbers, they need to stock. AutoZone's inventory increased 14.1% to $7.026 billion. That's much faster than the 2.4% growth in sales, which could be concerning. On one hand, higher inventory could be strategic. Maybe AutoZone is stocking up for anticipated demand growth. Maybe AutoZone is stocking up for anticipated demand growth or dealing with longer supplier lead times. Having parts in stock when customers need them is crucial for market share. On the other hand, excessive inventory ties up cash and creates markdown risk. If demand doesn't materialize, AutoZone might have to discount products to clear them out. The key metric to watch is inventory turns. How many times per year AutoZone sells through its entire inventory? Inventory turns slipped from 1.5 times to 1.4 times. That suggests inventory is moving a bit slower than it was last year. One positive note, accounts pay. This is very positive. One positive note: accounts payable as a percentage of inventory was 114.2%. That means suppliers are effectively financing more than 100% of AutoZone's inventory. This is a powerful working capital advantage that many retailers don't have. Net inventory per store is actually negative, minus $131,000. That means suppliers financing more than covers the cost of inventory at each location. It's like having suppliers pay you to stock their products. So what's the bottom line on all these numbers? Let's put all the numbers together. What does that mean? AutoZone is a company in transition. The core business is still healthy. Same-store sales are growing, cash flow is strong, return on capital is elite, and the balance sheet is solid. But margins are under pressure from inflation, wage increases, and higher operating expenses. The company is investing heavily in growth, which is pressuring near-term profitability but could pay off over time. The massive share buyback program means every dollar of the earnings is spread across fewer shares, which has been a huge driver of per share returns. But it also means the company is highly leveraged to its own performance. If AutoZone can navigate the current cost pressure and return to earnings growth, shareholders will benefit enormously from the reduced share count. If margins continue to compress, all those buybacks at high prices could look expensive in hindsight. So let's talk about what to expect. What to watch next quarter, what to expect for the next quarter. Based on this number deep dive, here are the key metrics I'll be watching in AutoZone's next quarterly report. Gross margin, can this stabilize around 41 to 42%, or will inflation continue to pressure margins? And we will also look at the same store sales. Is the 4 to 5% growth sustainable, or was this a good quarter in a challenging environment? Also, we need to look at the inventory turns. Do they get back above 1.5 times, or does lower inventory movement become a problem? Oh, don't forget the operating leverage. Can they start spreading SG&A costs over more sales, or will expenses continue growing faster than revenue? And regarding the commercial business growth, can this 6 to 7% growth rate continue? And can they expand margins in this segment? Before we move to the next section, I want to hear from you guys. I want to hear from your perspective. Looking at all these numbers, which metric do you think matters most for our AutoZone's future? Drop your answers in the chat. Drop your thoughts in the chat. Is it gross margin, same-store sales, inventory management, or something else entirely? And guys, if this detailed financial breakdown is helping you understand how to analyze earnings reports, make sure to hit that subscribe button. Thank you so much. We're doing great dives like this every week, teaching you how to read financial statements like a pro. The numbers tell a story. And AutoZone's story right now is one of a mature, profitable business dealing with some near-term challenges while investing for long-term growth. Whether that investment pays off will determine if this stock continues its decades-long winning streak, or if we're seeing the beginning of a more challenging period. Alright everyone, we just went through AutoZone's official press release numbers line by line, but that's only half the story. Now we're diving into their conference call slide deck. Let me show you. We just went through this part. Yeah, And we will switch to this part. This is a fourth quarter fiscal 2025 conference call presentation. If you click on this link, and this website will pop up, which is their PowerPoint. So this is a PowerPoint presentation management uses while they're talking to Wall Street analysts and big institutional investors. Think of this as AutoZone's chance to tell their story visually. The press release is just raw numbers, and these slides show you what management wants you to focus on. And they get to pick the charts, highlight the metrics they think make them look good, and frame the narrative exactly how they want it. This is where you can read between the lines and see what management is really worried about and what they're most proud of. So grab your coffee, hit that like button, and let's flip through this deck together like we're sitting on a Wall Street earnings call. First up, we've got the classic forward-looking statements page. Every public company states their presentations with this. It's basically the legal shield. Tons of tiny text that nobody reads, but everyone has to include. Here's what they're really saying. Look, we're going to make a bunch of predictions about the future, but don't sue us if we're wrong, because literally anything could happen. They list everything from fuel prices and weather to cyber attacks and geopolitical risks. So for beginners, think of this like the warning label on a prescription bottle. The front says, "This will make you feel better," but the back lists 47 possible side effects, including may cause nausea or something else. The key thing to understand is that every company includes these warnings, so don't panic when you see them, but smart investors do pay attention to which risks company emphasize most. AutoZone calls out things like miles driven, fuel prices, inflation, supply chain disruptions, and cybersecurity. Those are the things keeping management up at night. Now we get to the meat of the presentation. Q4 results, a tale of two numbers. AutoZone reported Q4 sales of $6.2 billion, up just 0.6% on a GAAP basis. But remember that calendar adjustment we talked about? When we talked about the press release, we have talked about that. Do you remember? When you remove last year's extra week, sales were actually up 6.9%. This is why you always need to dig deeper than the headline numbers. A 0.6% growth rate sounds terrible in today's market, but 6.9% growth sounds pretty healthy, especially for a mature retailer in a tough economic environment. The margin story is more concerning though. Gross margin fell to 51.5% and operating margin dropped to 19.2%. Operating profit came in at $1.196 billion and earnings per share was $48.71, down from $51.58 last year. Management is blaming two main culprits here. First, LIFO. LIFO accounting knocked $80 million off their profits. Remember, LIFO assumes you sell your most expensive inventory first. So when inflation hits, it makes your cost look higher, even if you're still selling older, cheaper inventory. A second, foreign exchange hurt them by $36 million on sales and $14 million on operating profit. When the dollar strengthens against other currencies, it makes overseas sales look smaller when converted back to dollars. Here's how to think about this from different investment perspectives. Let's talk about it from 3 different angles: the bullish, bearish, and neutral. The bullish take strip out the accounting noise and currency effects, and you see solid underlying growth. Same-store sales were up 4.8% in the US and 7.2% internationally on a constant currency basis. That shows real customer demand is strong. The bearish take, margins are getting crushed and earnings per share is declining. The company is missing Wall Street expectations for the 5th straight quarter. Without those accounting adjustments, the story looks pretty weak. The neutral take. The last angle, the neutral take. This is a classic AutoZone, steady but not spectacular. Not spectacular but steady. They're dealing with the same inflation and currency headwinds as everyone else, but the core business isn't broken. Full year results, the bigger picture. Zooming out to the full fiscal year, AutoZone generated $18.9 billion in sales, up 2.4% on a GAAP basis or 4.5% adjusted for that extra week last year. Earnings per share was $144.87, down from $149.55 the previous year. This full-year review really drives home the margin pressure story. Sales are growing, but profits are actually declining. That's a classic squeeze that happens when your costs rise faster than your ability to raise prices. Management points out that the LIFO accounting, management points out that the LIFO, the LIFO accounting was $64 million headwind this year compared to a $40 million benefit last year. That's a $104 million swing. Foreign exchange knocked on nearly $3.6 off earnings per share, but even accounting for those factors, the underlying profit growth is pretty weak. This raises questions about whether AutoZone can get back to growing earnings at the same rate they've historically delivered. The bright spots in the full-year numbers are same-store sales growth of 3.9% globally, with international practically strong at 9.3% on a constant currency basis, and they returned $1.5 billion to shareholders through buybacks, continuing their legendary capital return program. Let's talk about their growth strategy. 3 pillars. AutoZone breaks down their growth strategy into 3 main buckets, and this slide tells you a lot about where they see opportunities. The first is US retail DIY. That's regular customers like you and me buying parts to fix our own cars. This is a traditional AutoZone consumer base. The weekend warrior changing brake pads in the driveway. Second is US commercial DIFM. That stands for Do It For Me. DIFM, Do It For Me. These are professional mechanics, repair stores, fleet operators, and dealerships who buy parts but have someone else install them. This is typically a higher margin, stickier customer segment. The third, international. The third one is international expansion, primarily in Mexico and Brazil, where car ownership is growing and aftermarket parts infrastructure is less developed. What's interesting is that they're not trying to reinvent themselves. They're not pivoting to electric vehicle parts or launching some crazy new tech platform. They are doubling down on what they know works, selling traditional auto parts through physical stores to both DIY consumers and professional mechanics. This tells us management believes the core business model has years or decades of runway left. Decades of runway left, despite all the talk about the electric vehicles eventually changing the industry. New store highlights. Let's talk about the store expansion. The land grab continues. The store expansion slide shows AutoZone is still in aggressive growth mode. In Q4 alone, they opened 90 net new stores in the US, plus 45 in Mexico. That's 11% growth in their Mexican footprint, and 6 in Brazil, 16% growth there. For the full fiscal year, they added 304 net new stores. That's 43% more than their opening place the previous year. They're clearly accelerating expansion. Here's why this matters. In the auto parts business, convenience is king. When your alternator dies on a Saturday morning and you need a car for work on Monday, you're not going to drive 30 minutes to save $5. No, you're not gonna do that. You are going to the closest store that has the part in stock. AutoZone's strategy is to be that closest store. The more locations they have, the faster they can get parts to consumers, and the more likely customers are to choose them over competitors. But rapid expansion comes with risks. Every new store requires upfront investment, lease deposits, inventory, employee training, marketing, right? If the new location doesn't generate enough sales to cover those costs plus a decent return, it becomes a drag on overall profitability. The fact that they're accelerating the openings of the store while margins are under pressure suggests that management is confident in their site selection and believes these new stores will pay off. But it's definitely something to monitor. Domestic commercial highlights. This slide, commercial business. Wow, this is like a hidden gem. This slide is all about AutoZone's commercial business, and this is where things get really interesting. Domestic commercial sales grew 6% in Q4 and 6.7% for the full year. Average weekly sales per program per store hit $18,200, up 9%. Here's a stat that jumped out at me. 92% of United States stores now run commercial programs. That means almost every AutoZone location isn't just serving DIY consumers on weekends. They are also serving professional mechanics and repair shops during the week. This commercial business is incredibly valuable for several reasons. So the first, why the commercial business is so valuable? The first reason is the commercial customers order parts multiple times per week, so it's recurring revenue. And the second, when a customer's car is up on the lift and it needs a part right away, price sensitivity goes way down. And third, once a repair shop gets used to AutoZone's delivery schedule and credit terms, switching to a competitor is a huge hassle. Yeah, think about your local coffee shop. If you go there every morning and they know your order, you are probably not going to switch to a different shop just to save 50 cents on your latte, right? The commercial auto parts business works the same way. Relationships and convenience matter more than price. The fact that commercial sales are growing faster than overall sales, 6.7% versus 2.4% tells me the AutoZone is gaining market share in this valuable segment. That's a positive long-term trend even if overall growth is modest. From a bullish perspective, the bullish angle, the commercial business is building a moat. Those relationships are sticky and recurring, creating a stable base of cash flow that's less sensitive to economic cycles. And from the bearish angle, even with all this growth, it's still only mid-single digit expansion. In an inflationary environment, real growth might be even thinner after you account for price increases. And let's talk about the neutral angle. From the neutral angle, steady, dependable growth in a critical segment, not explosive growth, but the kind of steady progress that compounds over time. Now let's move to the next slide. Balance sheet highlights. The balance sheet slide tells an interesting story. Inventory jumped 14% to $7 billion. That's $918,000 worth of parts sitting on the average store's shelves. Meanwhile, inventory turns slipped from 1.5 times to 1.4 times, meaning parts are sitting on shelves a bit longer before being sold. This inventory buildup could be good or bad. Now let's talk about it. Why it could be good and it could be bad. So on the good side, maybe they're stocking up to avoid the supply chain shortages we've seen in recent years. Or maybe they need more inventory to support all those new stores they are opening. On the bad side, if demand slows down and they're stuck with all this inventory, they might have to mark it down to clear it out. Plus, inventory ties up cash that could be used for other investments or returned to shareholders. The debt picture looks healthy. Total debt declined slightly to $8.8 billion. Shareholders' deficit improved from negative $4.8 billion, from negative $4.8 billion to negative $3.4 billion. Remember, negative shareholders' equity isn't necessarily bad for a company doing aggressive share buybacks. It just means they've returned so much cash to shareholders over the years that the counting value of equity has gone negative. Working capital is still negative at negative $1.2 billion, which is actually a beautiful thing for retailers. It means suppliers are essentially financing their inventory through payment terms. AutoZone gets to stock their shelves. AutoZone gets to stock their shelves with parts and pay for them later, using supplier credit as a form of fee financing. Now let's move to management's vision, building shareholder value. What does that mean? The final slide of this PowerPoint is classic corporate speak. Leave the pledge, consistent EPS growth, powerful free cash flow, disciplined capital allocation. This is management's attempt to wrap everything up with inspiring buzzwords, but let's decode what they're really saying. Their strategy boils down to 4 main points. First, keep growing earnings per share through a combination of organic growth and share buybacks. Even if total profits are not growing fast, they can boost EPS by reducing the number of shares outstanding. And second, generate strong free cash flow. Generate strong free cash flow to fund both growth investments and shareholder returns. They need enough cash to open new stores while also buying back billions in stocks each year. And third, return excess cash to shareholders through that legendary buyback program. AutoZone has been one of the most aggressive buyback stories in the market for decades. And the last one, keep pushing growth in all three segments: DIY, retail, commercial, and international expansion. So look at this slide deck as a whole. Here's what jumps out at me. So what does this mean? For our investors, management is clearly trying to emphasize the positive part of their story: same-store sales growth, commercial business momentum, international expanding, and their track record of returning cash to shareholders. But they can't hide the margin pressure and earnings decline that's been going on for 5 straight quarters. These slides do show a good job explaining why earnings are down: LIFO accounting, currency effects, inflation, but explanations don't change the fact that profitability is under pressure. The aggressive store expansion pace suggests management believes they can grow their way out of the margin squeeze. More stores mean more revenue, and if they can get operating leverage from those new locations, margins should recover over time. The commercial business growth is probably the most encouraging part of this whole presentation. That's sticky, recurring revenue from customers who care more about convenience than price. If they can keep gaining share in that segment, it provides a foundation for long-term growth. Alright folks, before we wrap up this section, I want to hear from you in the chat which part of the AutoZone's growth strategy gets you most excited: the DIY retail expansion, the commercial business, or international growth? Drop your thoughts. Let me know your thoughts in the comments. Let me know your thoughts in the chats. And if this slide-by-slide breakdown is helping you understand how to read corporate presentation like a Wall Street analyst, smash that like button and subscribe from the YouTube channel. And subscribe for more content like this. We're teaching you the skill to evaluate companies like the pros do. Coming up next, we're going to do more analysis like this. So please subscribe, make sure you don't miss anything. Alright guys, that wraps up our deep dive into AutoZone's Q4 earnings. I hope this analysis shows you how to read financial statements, decode management presentations, and think critically about investment opportunities. If this content was valuable, here's how you can help the channel grow. Smash that like button. It actually makes a huge difference in how YouTube promotes this video. And you can click on the pinned message in the chat, join our WhatsApp group, and subscribe and hit the notification bell so you don't miss our weekly earnings breakdowns. And most importantly, share this with someone who's trying to learn about investing. The best way to support independent financial education is to spread the word. Drop a comment and let me know what company you want us to analyze next. We're taking requests from upcoming earnings seasons, and I love diving into business I haven't covered before. Also, if you found this analysis helpful, consider sharing your own thoughts about AutoZone in the comments. Did I miss anything important? I hope I didn't, but you can remind me. Thank you so much. Do you disagree with my conclusions? The best investment discussion happen when we challenge each other's assumptions. So, investing isn't about finding perfect companies. It's about finding good companies at reasonable prices and holding them long enough for their business fundamentals to drive returns. AutoZone isn't perfect, but it's a good business with a strong competitive position, excellent management, and a track record of creating shareholder value. Whether that makes it right for your portfolio depends on your goals, risk tolerance, and time horizon. And hopefully, after today's analysis, you have the tools to make that decision thoughtfully rather than emotionally. Remember, the goal isn't to get rich quick. No, it's to build wealth steadily over time through disciplined analysis and patient capital allocation. Companies like AutoZone might not be the most exciting story on CNBC, but they are often the foundation of successful long-term portfolio. Folks, my friends, thanks for joining me for this deep dive. Keep learning, keep questioning, and keep investing in your financial education. That's a real path to long-term wealth. Until next time, this has been your earnings breakdown. See you in the next one.